Hi, I'm Ben Reppond. Today is November 1, 2022. Welcome to my YouTube broadcast. I'm doing some things different this time. One, I am taking the portion of the video that I've done in the past and putting it into a separate video. So the portion at the end, which includes the stock market, the indicators, dashboard, stock market data, etc., I'm putting into a separate video, and so you'll see that. That will not be part of this one, but it will be separate, and you'll be able to find it on the channel. The second thing I'm doing is I'm updating the video that we produced in the past, which is how we manage money. And now that we've gone through a good portion of 2022, I think it would be instructive to update that in light of where we are right now. And I think it will have more meaning with the adaptation that I've done. So right now I will cover this portion, and it will be the way it's going to be on the website. Following this will be the portion related to the economy, the financial markets, the Fed, debt, etc., that really is shaping the financial landscape right now. I want to describe our philosophy of investing and the methodology that we use to invest money. The first thing that we attempt to do is to minimize risk. And the way we minimize risk is to get out of the way of a falling market. We want to do that as much as possible. We want to get out as early as possible, and we want to get back in as early as possible. But we want to be out of the market, sitting on the sidelines in a falling market. That's our number one priority. Second priority is to participate in the upside of the market. So as the market goes up, there are these periods of time where the market does very well. There may be some degree of minor volatility, but in general, it's an uptrending market. We want to participate in that. So we do not use bonds. So we're using equities or we're using cash. Cash means the money is just sitting there and it's accumulating some small amount of interest. The way we do this is that we have a risk detection meter. And what we're trying to do, we're not trying to measure the stock itself. We're trying to measure risk that is coming into the market, and we think it's quite accurate. When risk comes into the market, that's our indication that we need to get out of the market. And sometimes risk is not detected in the equities. It can occur before the stock market actually starts to go down. But we think it's a good measure, and it's easier for us to model that way. I want to show you 4 charts. I'm picking a period of time. This illustrates my point to show you what we do. So I will show you 4 charts from October of 2019 to October of 2022. The first chart covers from October of 2019 to February 19th, 2020. So you can see the blue line represents the S&P 500, represented by the ETF SPY. And you can see that the market goes up for that entire period of time. That's a period of about, 4.5 months. So I put a black circle around the dip toward the right of the chart, and that is not a period of time we would get out of the market. And when you really look at this correctly, that dip is only about 3.5%. So it's not very much, and that would be not enough to shake us out of the market, and that's a good thing. And that's the reason we use risk, measuring of risk rather than price, to determine whether to get in or out of the market, because that does not indicate risk has come into the market. So easy enough, we would be invested during a period of time like this. Following February 19th, 2020, I'm going to add this on so you can now see the black line represents what I just showed you from October to February 2019, 2020. And then look what happened. Of course, this is COVID, the pandemic. So you can see that the market went down, and it went down quickly, sharply. And that's represented by the red arrow. We actually got out of the market in late February, early March, right at the very beginning of the downturn. And this goes all the way to the bottom. So when this happens, there's only one thing you need to do, and that is get out of the way. And then when it turns around, and it did at the end of March, and goes back up, we'll look at that next. Traditional financial advisors do not use a method of getting out of the way of the market. They believe in putting together assets that they believe work best together. Usually it's stocks and bonds plus some other small allocations, and then just let you ride it all the way down, making no changes. Sometimes that works, and other times it doesn't work at all. We'll cover that later. Now let's look at what happens after March of 2020. At the lower left of this chart, you can see the black arrow that goes up and the red arrow that goes down. That is a compression of what I just showed you before. That is October 2019 to February 2020, and then the red line down is the 5-week period from the end of February to the end of March. At the end of March, Chairman Powell, Federal Reserve Chairman, said, it was panic time really, and he said to prevent losses or the further collapse of the economy, that he was willing to print unlimited amounts of money. And as soon as he said unlimited, the market took off. And that's why you see the sharp down arrow, the red arrow, and the long ride up, a very steady ride up for the S&P for quite a period of time. All the way, this takes us to the end of 2021. So this would include the rest of 2020 and all of 2021. So a period of about a year and 9 months. So that gets us to the end of 2021. Now let's take a look at what happened then. You can see pretty much right at the beginning of 2022, the market went down. And as it went down, that's represented by the second red arrow, and that's 2022. And then in July, the market went back up, tried to recover, but it couldn't. It basically had entered bear market territory, and by any definition, it was bear market territory, and there was more damage to be done. So the red arrow to the farthest to the right represents the continuation down of the market following that attempt to go up in July. So the way we manage money is that we look at these opportunities, these red arrow opportunities to get out of the market. We want to be out as much as possible during that period of time. So far, we've been able to do that. We think our method is sound, and it has been proven to be sound. And then when the market's going up, we want to participate as much as possible. But to the extent that we can eliminate the red arrow periods of time, this, in my opinion, is the key to successful investing. Because successful investing has two components: bear market conditions and bull market conditions. In bear markets, we don't want to be there. We want to be sitting on the sidelines, and we think in protecting assets and then be fully invested during bull market periods. And with our risk detection meter, that's our method for determining when those red arrow periods occur and when the black arrow periods occur. This slide covers a period of time of 9 years. And the reason I show it, because it shows some macro periods. During the period of time from February of 2000 all the way down to the bottom, represented by the red arrow on the left, all the way down, that takes us to March of 2003. That is a period of time that we want to be out of the market as much as possible. With our risk detection meter, this is not hard, because it would start to flash red very quickly in there. Somewhere in that period of time in March of 2003, it would turn positive, and you can see where it went up until the very top, which was October of 2007. When the market started down in October of 2007, we would be getting out of the market as quickly as possible. We don't know what's ahead of us. We never know what's ahead of us. All we know is that when the risk detection meter goes off and it says you need to be out of the market, we get out of the market. When it says it's time to come back in, we don't question it, we come back in. Sometimes neither one of them feel like the right time to get in or the right time to get out. But we don't go by our feelings, we go by the mathematics of our system. And then you can see what happened in the balance of 2007, 2008, and even the beginning of 2009. This is not a period of time that people need to be in the market. But traditional financial advisors will leave people fully invested during this entire period of time, virtually all of them. Now, there could be an exception, but most of the ones that people have told me about believe in the concept of just leave your money in, let it ride all the way down to the bottom, let it ride all the way back up, and then all the way back down again. So you can see what happens here is that over time, there are gains. When you participate in the market, there are gains, and people get comfortable with that. Financial advisors get comfortable with that. But then when down markets appear, when they, for whatever reason, reasons are always different, but when that happens, it begins to strip away the confidence of investors and certainly strip away their money. For a younger person, sometimes it's easier to accept this, but as a person gets older and they start approaching retirement or they're in retirement, this is something that most people cannot handle. And they cannot handle it emotionally and they cannot handle it financially. But these are two periods, perhaps you remember these in our past. And then in the beginning of 2022, we have now entered a new bear market. Clearly, all indications are that we are in bear market territory. How far down is this going to go? We will only know that in retrospect in the future. But it looks like a lot of conditions are present that will cause severe losses in the future. When you think of bear markets, there are three phases to a bear market. We have just experienced the first phase. The final phase, I'm just going to go from the beginning one to the end one. The final phase is a period of time where that's at the very end when people give up. they're exhausted, they are despondent. Sometimes they even just sell everything because they can't take the risk. They don't know how much further down it's going to go. There's no indication it may just keep on going further down. But emotionally, people can't handle that. In 2022, we experienced a period of time that is kind of a light bear market. It's not very deep. The S&P went down about 25%. These losses here are more like 50% losses. And so when that occurs, then that's where, toward the end of that, is where investors just throw in the towel and want nothing to do with the stock market again. Mike and I have spent thousands and thousands of hours of researching one question. The question is, how can we best protect money, the downside risk of money invested? How can we best do that and participate in the upside of the market? So that's what we want to do. The one single key for successful investing is to understand this and have a way to get out of the market when the time is right to get out of the market. And unless you have a method to do that, a mathematical method to do that, or at least that's what I prefer, you're going to go down a long, long ways. And the further you go down, then you are motivated, I need to do something, I need to do something. And you start to have these thoughts and these feelings. The financial advisors may have them too, but they don't have a method. The traditional financial advisors don't have a method to do that. Alternative advisors do. We fit in the alternative camp, and we believe that there's a way to protect the vast majority of this money and a way to participate in the upside of the market when that occurs. There's one more thing I want to mention, and this comes into play here. There are two types of advisors. One is a fiduciary, and one is not a fiduciary. The vast majority of the financial advisors are not fiduciaries. And you may not know that. They're not going to put that on their website or their business card. They're not going to say, we're not a fiduciary. It's buried in the fine print. You have to know what to look for and where to find it. It's almost impossible to find. I know where to look for it, but most people couldn't find it. And but it's a very big thing because it comes about from licensing. If you have a license that allows you to be a non-fiduciary, you're able to sell products. You can sell commission products, annuities, insurance, funds, mutual funds that have loads and commissions in them, etc. And a fiduciary, however, is not able to sell those and cannot sell them, doesn't want to sell them. Because a fiduciary means that you can't accept commissions, and you have to put the client's interest ahead of your own. You cannot be doing anything with the money of a client that puts your own interest ahead of theirs. And this type of investing would be a way that you could see that a fiduciary would say, yeah, you need to get out of the way of this kind of risk. And a non-fiduciary would say, I'm just going to invest your money. I'm going to continue to make money from those mutual funds, and I'm going to charge you a fee all the way down to the bottom. And we'll ride it all the way back up. But for the investor, that becomes a very frustrating experience. Next, I want to show you a chart which is the S&P 500 for the past 12 months. What you can see, I drew a black line down it, and you can see that the long-term trajectory, at least for the last year, for the S&P 500 is the market is in a downward trajectory. However, during the past couple of weeks, the market has gone back up. You know that, probably. And what I did was mark that at the end of the chart. I circled it so you could see that represents the move up by the S&P 500 for the past 2 weeks. But the long-term trajectory is still down. I don't know how long this move up is going to continue. It's been a nice move up, and there was a positive GDP report that I think was the cause of most of it. But I think it's going to go for a while, I think. And then it's going to collapse. And just like the periods of time throughout this year, I think it's going to collapse and go on back down further. But I wanted to show you a piece of good news, because as we talk about risk in the market and risk that's in front of us, to say we've had a couple of weeks that have been positive, that's a good thing. Next, I want to show you a video from CNBC. This is Mohammed El-Arian with Becky Quick, and he explains these most recent moves in the market. I think he does it really well, and I won't repeat what he says, but it's a very good explanation. And he ties it to liquidity, not to the fundamentals of stocks and earnings. And I think you'll find it interesting. Here's Dr. El-Arian.
Mohammed, we're going to talk about what's happening in the UK in just a moment. But first, let's just talk about the markets this morning. Equities up again, and this is happening as yields are coming down around the globe. What's the message? That sounds like it's bigger than just a thought that maybe the U.S. Federal Reserve is pivoting.
So we shouldn't take much comfort from the yields coming down around the world, because they're coming down on growth concerns. The European PMI numbers were horrible. Germany is at 44. And in China, while the GDP numbers beat, there's a lot of question marks about it, especially given what's happening in retail sales. I think what's happening to our market, and it's wonderful to have the best week since June, it's wonderful to see the rally continue, is that we've redefined what a pivot is. We've redefined it from meaning lower rates to pausing to slowing. And if you redefine that, then you will have a liquidity effect. And that's what we're getting. We're getting a liquidity effect rather than a fundamental effect.
In other words, we've lowered our standards and we'll take anything at this point, just stop the beatings?
Yeah, and there's reason for that, because there is significant value in certain parts of the market. So yes, if you just need a catalyst. The one thing I would caution, you heard from Roger Ferguson earlier today, that this is not because of inflation. Inflation hasn't turned around. Core CPI continues to go up. This is because of financial stability. There's concern that this front loading of rate hikes, and it's massively front loaded, will break something in the financial system. So if the Fed does slow, it is because we have financial stability concerns.
That's really bad.
Well, it depends. I mean, if they stop it from getting worse, and if this doesn't harm us and makes us end up in stagflation, it will be good. All I want to say is this is a trilemma. It's not just growth versus inflation. It's growth, inflation, and financial stability. And somehow the Fed has to find its way through this, as does the ECB, as does the Bank of England.
This is a clip from Nouriel Roubini, and he is a stock market expert. And he explains why he believes, and it's kind of taken from his book, why he believes that the stock market is in fact going to crash, and that is tied to the Federal Reserve's determination to raise interest rates to push inflation from the current level of 8 to 9% all the way down to 2%. Chairman Powell has made it very explicit, very clear, very emphatic that he is determined to push inflation down to 2%. And the code word for that is he is determined to do that if it means crashing the economy. And every expert that I can find all agrees that that's what it means, and Chairman Powell knows that. So we are in a bear market, as he points out, and I would say, by all forms of the definition, we are in a recession. A recession is defined as 2 quarters of contraction, and we've had those 2 quarters. So I say we're in the bear market, and we're in a recession. Now, when they talk about a recession coming, I don't know what that means, because it seems like we're in one. So how could one be coming? So, but here is Nouriel Roubini, and I think you'll find this interesting.
There is an issue, though, going forward with the central banks, and whether a lot of your thesis, Nouriel, is predicated on their inability to go through with what they need to do to get inflation down. Is that your base case? Is that the most likely outcome?
Yeah. Right now, all central banks are playing tough and talking tough and acting tough, hawkish, because they have a problem of credibility. But in my view, there are 2 problems. One problem is that if they try to get to 2% inflation, they cause a recession. And this recession is not going to be short and shallow. It's not going to be garden variety. It's not going to be plain vanilla. It's not going to be 2 quarters of negative growth, then inflation collapses and they can ease again. In the book, I explain all the reasons why it's going to be a severe recession because of the debt ratio, because we're going into fiscal and monetary tightening. And at the same time, not only you have an economic crash, you're going to have also a fiscal crash. We're not only in fiscal dominance in this game of chicken between Treasury and central bank, we're in what the folks at the Bank of International Settlement call a debt trap. There is so much private and public debt that if central banks try to fight inflation, they cause a crash of financial markets, and not just the stock market. That's the least important. Credit market, bond markets, and that crash and financial crash feeds on the economic crash and vice versa, and therefore they're going to wimp out and they're going to blink. And the first one was the Bank of England. The Fed is going to do the same. The ECB is going to do the same.
Have you been surprised that we haven't seen some sort of catalyst, some sort of financial stress so far, given how quickly the Fed has already hiked rates?
Well, we have not yet seen it. Some people worry that some major financial institution, not in the US, may go bust. I think that the financial strains are going to become more severe because right now the Fed is on the way to go from 3 towards 5%. You already have a stock market down 25%, NASDAQ even more, public REITs 33%. You have the crash of MIMI, of SPAC bubble, of the crypto bubble, private equity, venture capital, growth, everything is down. Credit is down. Leveraged loan market is shutting down. CLO market shutting down. And the only thing that used to be safe, there were government bonds. Now the price is correlated positively with equities. Because when inflation is rising, you lose money on your equity side, you lose money on your bond side. Yields have gone from 1 to 4, and the price action downward on bond has been worse than in equities, 30% losses. So any 60-40, 70-30 or risk parity portfolio lost money on both hands. There was nowhere to hide. Even cash gave you a negative real return because of inflation. There are other alternatives that can protect you against this tail risk, but they're not the traditional ones.
I want to switch gears from the economy and the Federal Reserve and interest rates and inflation. I want to go over to, this is something that's coming up a lot in the news, at least the news that I read, is that there is a diesel shortage in the U.S. and in other parts of the world. This is very significant. You may think, well, I don't have a diesel truck. So why does that matter? Go to the gas pump and I buy gas. Well, it does matter because the food that we consume is all produced with diesel equipment. On every farm, all of the equipment is run on diesel. The trucks that take the food from the farm to the processing plant to the warehouse, and the warehouse to the retailer, all run on diesel, all of them. Trains run on diesel. Buses run on diesel. Airplanes run on diesel. Diesel is a big part of our economy. I happen to drive a diesel truck, so I'm aware of the price of diesel. It's quite high. But what we're talking about is not just the cost of diesel, but the availability. Diesel, and I cannot explain why, but diesel, the supply has been depleted. And I saw this past week an article that said, and I've checked it with multiple news sources, that the United States is down to a 25-day supply of diesel. In other words, if no more diesel is added at the current rate of consumption, we will be out of diesel in 25 days. Well, we are adding to it. So I'm not saying that we're going to be in 25 days, we're out of diesel. I'm just saying that's how much of a supply we have left. And that is critically short. That's about 60% less than where we should be at this particular time of the year. So Newsweek has an article, diesel shortage update, as prices skyrocket over fears that the supply could run out. So I don't know what that means and what it is going to take to cause us to run out, but when I hear diesel, I equate that to food. So if this becomes a crisis, then what we're talking about is probably in our country a lot of people starving to death, and hard to imagine, or that those who can afford it will be paying much, much higher prices, and the consumer is already being squeezed. So the impact in our economy and to the individual consumer is going to be significant, and this is in the coming months. I expect this to be during the winter of 22-23. I want to play a clip. This explains, it's just a video. It's, and I don't know the person that did it, but it explains pretty well. It's I think it's 3 minutes. And it explains really what's going on in Europe and the U.S. But Europe is in much greater peril than the U.S. regarding food and regarding diesel. So I think you'll find this interesting. It explains really what's going on over there. And they have so many problems with inflation and interest rates and bonds, and it's just much, much worse than here. But we in the United States are tied to Europe, probably as much as any other part of the world. So if they have a problem, we have a problem. So take a listen.
Europe needs solutions, not problems. Tragically, though, Europe's pile of problems and crises just keeps increasing. The latest crisis to knock on Europe's doors has a lot to do with diesel. You see, Russia has been Europe's largest supplier of diesel for years. Russia, until recently, provided Europe with close to 50% of its diesel requirement. But Europe has been shooting itself in the foot for months now. As a result of that, some players in Europe decided to stop purchasing Russian diesel. Then, the European Union decided to ban imports of Russian oil beginning the 1st of December. And that embargo is yet to kick in. But Europe can already feel the pain of parting with Russian diesel. Europe is a net importer of diesel, jet fuel, and heating oil. As such, why it chose to mindlessly ban Russian oil imports is something nobody can get their heads wrapped around. Demand for diesel skyrocketed across Europe as high natural gas costs and a supply crunch pushed consumers to switch to diesel. Now, diesel inventories are running worryingly low. For Europe's industry, which relies heavily on diesel, now that natural gas is out of bounds for it, the situation is horrifying. According to the head of Spanish oil refiner Repsol SA, loss of Russian diesel supply combined with disruption in fuel production in France have left parts of Europe short of supply. The CEO of Repsol said, "We are running out of middle distillates in some European countries. There is room to see high diesel prices in the coming months." Russia is not the one contributing to a diesel crisis across Europe. Recent protests in French oil refineries have led to diesel output dropping dramatically, and that has pushed inventories across Europe even lower. Now, Europe is importing more diesel. However, it isn't being able to match up to the volumes that Russia supplied it with almost effortlessly. And this is when, mind you, an embargo on Russian oil is yet to kick in. Once that embargo does kick in, Europe will have a lot to worry about. The diesel crisis is not exclusive to Europe alone. For months now, US diesel fuel inventories have been decreasing. The United States currently has just 25 days of diesel supply in reserve. Goldman Sachs has warned that the diesel shortage in Europe and the United States could increase fuel prices this winter. Mind you, Europe has been counting on the United States to solve nearly all its problems. However, Washington's ability to help Europe is shrinking at a really fast pace. In fact, the diesel situation in the United States is such that traders have been forced to divert diesel and jet fuel shipments that were destined to service the European market back to USA's East Coast. The diesel shortage is only set to get worse before it gets any better, and Europe is not prepared to deal with the natural gas and diesel shortage together. How a shortage of both these fuels will upend the energy markets and prices of fuel is another crisis Europe is not prepared to face.
This morning, in this morning's news, I read it was a Bloomberg piece, and it said the world's food security, I call it supply, the world's food security is at stake as Russia exits the grain deal. Well, I read the article and looked at what was the deal that they made regarding grain. And what the deal was that Russia had agreed to facilitate, to not block the shipment of grain from the Ukraine to Europe and to the rest of the world. Other than the Black Sea, the Ukraine is basically landlocked. They have an exit out the Bosphorus to the Mediterranean, and other than that, they rely on pipelines and trucks and so forth to move their food from the Ukraine to the rest of the world. Russia has backed out of that deal, and it appears from the way the article was written that Russia is going to actually block the shipment of grain from the Ukraine to the rest of the world. Ukraine supplies 40% of Europe's food, and they do supply all kinds of food for the rest of the world. So again, we've got a diesel issue, and then we've got this, which happened this morning, that Russia is now going to be blocking the shipment of food out of the Ukraine. Finally, I want to play a brief clip from, this is Judy Shelton being interviewed by Joe Kernan on CNBC. And she explains that the whole world is very fragile right now. You may be feeling that. And she's looking at all of the data, not just in Europe, but in the US and around the world, and saying, we are, I don't know if we're at a tipping point, but we are in a very fragile system, and it doesn't take much. We saw this with the bailout by the Bank of England for the pension bonds in their country, and if the Bank of England hadn't stepped in, the pension system would have collapsed. It was that critical. And but we are critical here. There's other countries around the world that are in a similar condition, but debt is incredibly high. We had 31 trillion in debt, but we are adding to that debt at the rate of about 2 trillion a year. On top of that, we have another 6 trillion. So Trump added to that by a couple of trillion, and then Biden did the infrastructure deal with another 4 trillion. So there's 6 trillion on top of the 2 trillion of negative spending. So that's about 8 trillion of deficit this year. So the debt is escalating, and then to compound our problem, the interest rates have gone up, and of course we as a country pay those same interest rates, and so interest is going higher and higher, and the debt is going higher and higher, and we have no intention of paying back a dollar or paying back any of the interest. So we got the Federal Reserve going at it with printing money, and the Treasury going at it with adding more and more debt with no plan to repay it.
was kind of interesting for Bailey. Suddenly, it almost looked like he said, "Wow, here's my chance." After years of the bankers leaving interest rates at zero, so that pension plans couldn't fund their future liabilities, so they had to go into these esoteric and risky derivatives. So that's what they had. That they sort of forced that move. And then they saw an opportunity to say, hey, it wasn't us. You proposed these tax cuts. This has nothing to do with us. When that's what really caused the unraveling in the first place. And now you can see they aren't taking the blame. She's gone after what we called 4 Scaramucci's, which is 4 times 11, right. 44 days. She's gone, and the central bankers suddenly are being commended for doing enough to stem the sell-off and the gilt. So they're not supposed to be political either, are they?
Well, no, and that's the problem, that central banks have become increasingly political. I think this was a terrible example because it was the former central banker, the head of the Bank of England, Mark Carney, who within days of the announcement of that pro-growth tax cut regulatory burden for the private sector, empower entrepreneurs, he badmouthed that in a BBC interview and said, well, that's working at cross purposes with our central bank. So he put the central bank's agenda, which had just done the switch from the easy money to now they're very committed to tightening money. They haven't really achieved price stability whatsoever. So I think they've failed. They've left the world with an extremely fragile international financial system, highly vulnerable to these kinds of market dysfunctions. And every time we have a meltdown, the central banks, who should have been predicting it, if anyone was, they're responsible for calibrating money and credit to the needs of the real economy. They end up avoiding the blame and then use that as a rationale for why they should have even more powers to influence economic outcomes.
Finally, I want to give you a flow of funds report. This shows, and this is interesting because this last week, the last couple of weeks saw the stock market go up, and the bond market was not as favorable, but the stock market certainly went up. But the conventional equity funds had an outflow of $11 billion, and the bond funds had an outflow of $13 billion. Interesting. And money market funds even had outflows of $371 million, about a third of a billion. Finally, I want to cover, we've got the World Series going on. As of today, they're split. The Phillies have won 1 game and Houston has won 1 game. And did you realize that in the last 100 years, the 3 times that the Phillies won the World Series, the stock market crashed? All 3 times. 1929, 1980, and 2008. Just a bit of trivia. Just thought I would pass that on. I don't know how those two get correlated, but somehow there is some kind of a connection there maybe. I don't know. Thank you for watching. If you have questions or comments, leave them in the comment section and I'll respond to them. Thank you.